signs of strength. The GDP jumped 3% in the second quarter. That's far outpacing forecasts. It also represents a sharp rise from first quarter figures. On the heels of this new GDP data, US President Donald Trump once again called for an interest rate cut to, as you can see there, no avail. Meantime, Mr. Trump is ratcheting up the pressure on India to secure a trade deal with the US before Friday. The president is threatening a 25% tariff hike, along with unspecified penalties for buying Russian oil. Let's get more on all these strands as we keep an eye, of course, on Jay Powell, who started to address, of course, the press. Jason Furman served as top economic advisor during the Obama administration. He's currently a professor at Harvard University's Kennedy School of Government. Jason, great to see you. We are listening. We are monitoring what Jay Powell is saying. We'll listen to the questions. I think that's the most interesting point right now. Fed holding rates unchanged, the fifth consecutive meeting, of course. The interesting part on my end, and I'm sure you're going to give me more detail here, is the fact we're seeing dissent in these votes. What did you make, first of all, of the decision to hold and the dissent that we're now seeing within the Federal Reserve?
So it's great to be with you. The decision to hold rates steady seems just about right to me. In the first half of this year, we've had slower economic growth. That says cut rates. We've also had faster inflation. That says raise rates. The Fed is uncertain about all of it. And when you're uncertain, you wait, you collect more data, you don't move. As you said, two governors did dissent. As a general matter, I think it's healthy when there's dissent within a committee. I think it functions better with difference and debate. I think it's totally reasonable to have thought you should cut rates by 25 basis points. It does sadden me a little bit, though, that all the Biden appointees were on one side of the vote and all the Trump appointees were on the other. That's not the way the Fed has historically worked. I wish it wasn't that way right now.
Can you expand on that? I mean, it's interesting because one of those who actually dissented, and I'm sure you might have more information on this, one of the people that actually dissented is considered potentially one of the favorites to be the next Fed chair. How politicized is this becoming, in your view?
Look, Chris Waller is the person you're referring to. He's given some speeches recently that were, I think, very, very thoughtful in articulating why he thought rates should be cut. His core argument is that the increase in inflation is transitory because it's the tariffs and that will level out over time. I don't think that's at all a crazy view. And by the way, he asked for 25 basis point cut. President Trump is out there asking for a 300 basis point cut. President Trump's view is, frankly, in technical economics speak, nuts. That is not a view any respected person would have. Chris Waller is well within the normal range, so it doesn't bother me that much that he's advocating that.
And of course, we'll wait to see how Jay Powell, of course, answers some of these questions, in particular over the dissent. But there is a 64 probability, according to the CME watch tool, of a 25 basis point reduction in September. Just, why is a question that I was asking Richard Quest earlier in the show. Why then? What numbers would they be looking for? What kind of clarity would they be looking for here, Jason?
Right. So there's two things that could drive a rate cut. One is that inflation eases, and so they get more comfortable. The other is that the real economy, probably the job market, deteriorates, and so they get more nervous about the economy. I think if we get a rate cut, it's likely to be that second path. It won't be because they're feeling good about where inflation is. It's because they're feeling nervous about what's happening in the job market. And I should say, by the way, I would bet against a September rate cut based on what we know right now. And I would also add, I don't think Jay Powell knows what he's doing in September. He's going to be looking at the data. So any signals anyone takes from today's press conference, they're as likely to be misunderstanding him. I think he's going to be trying hard not to say anything.
Jason, do stay with us. I want to go straight to Washington. Jay Powell speaking. Let's listen in.
In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable. Which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. I couldn't point to it 6 weeks later.
You've been listening there to Jay Powell. As you can see, a decision was made in the last, 44 minutes, of course. Interest rates haven't remained unchanged for the fifth consecutive meeting. He's been answering questions. We know in the last 44 minutes also that there was dissent within the ranks and 12 members voting, two of them dissenting. And it's the first time, in fact, they have dissented in 32 years. Jay Powell's being asked a question about the arguments that he found most compelling for the dissent. He also spoke about said they did not made a decision about September, about cuts in September. Even though we've heard from President Trump today that he wants to see rates change in September. I was speaking to Jason Furman just before we were listening there to Jay Powell, keeping an eye also on the Dow Jones. It just turned on, there it is, it's still on the screen. It's just turned negative, but not dramatically. Jason, anything there that stood out to you? I mean, I heard words that we've heard repeatedly. Uncertainty has diminished. Still many uncertainties, a dynamic time, but clearly the tariffs and the uncertainty around these tariffs are key to the decision.
Yeah, exactly. I mean, he once again didn't really tip his hand. He said we're uncertain about what the policy is, even if some things have gotten a little bit more locked in. They were uncertain about the consequences of that policy and that they're going to be looking at the data over the next two meetings to make their decision in September. I'd say the one thing that struck me is his tone about how the economy as a whole was doing was better than my own interpretation is. He was pretty dismissive of the idea that growth is slowing, even though if you look at the first half of this year as a whole, you do see a market slowdown in growth. So if anything, that says maybe the bar to him cutting rates will be a little bit higher than I might have previously thought.
What did you make of how he answered that question from the New York Times journalists about the dissent within the Federal Reserve over the rates cuts? I think the question was, what was most compelling to you in terms of the arguments? What did you make of what he said there?
Look, the most important thing is he is an adult and he is managing a committee. He is being respectful to everyone in the committee. He's talking about their substantive disagreements, and these choices are complicated. There should be substantive disagreements. So the most important thing I took away was just relief and gratitude that we have an adult running that organization at a time that is fraught and complicated.
Well, we'll see what happens, but he said we have made no decision about September, that we have by then two jobs reports and inflation data. So we'll see if that data, as he said, does inform some of the risks in the coming months. Jason, appreciate it as always. Thank you very much.